It's been a busy week in the global markets as 4 central banks have announced their interest rate decisions. But if that wasn't enough, the Bank of China also made a surprise announcement as it cut interest rates for the first time since 2008. Joining me on the phone now for a retrospective look at this week's central bank decisions is Thierry Cottet from Merrill Lynch Bank in Zurich. Thierry, thank you for joining me. Now, starting with China, the central bank cut benchmark interest rates by 25 basis points in a surprise move today as it attempts to reverse a slowing economy. As the first rate cut in 4 years, do you think it's significant that they should choose this week to announce this decision on the back end of a week of rate announcements globally?
Let me first highlight our base case position. Our base case position is the one of a low growth globally where risky assets will perform better than conservative one for 3 main reasons. We believe that the policy response from Europe, US and Asia will be positive, that we have undervalued asset and abundant liquidity, and that the good earnings, especially in the US, will be sustainable. This being said, on the case of the Chinese economy, we believe that the Chinese economy will have a soft landing, and this recent move, although modest, is significant because it confirms the more dovish stance of China. And the risk of a sharp slowdown is going to be addressed by the government, and that is being shown by this recent move.
The Reserve Bank of Australia moved its official interest rate to 3.5%, its lowest level since November 2009, amid the global financial crisis. This was considered an unsurprising reflection on cautious households and businesses. With inflation expected to remain low in the short term, do you think this will spur on weak stock and property markets, particularly now in light of China's central bank rate?
This reaction from the Australian Reserve Bank is actually more like an attempt to prevent further weakness rather than to spur a rally at the short term. So it is considered to be a move which would be to prevent to have further weakness in the sector.
The Bank of Canada maintained interest rates at 1% on Tuesday, despite confirming global financial turbulence is creeping closer. If we look at this in contrast to RBA's dramatic cut, is there something to be said for remaining consistent and looking to wait out the crisis, or do you believe they should have responded?
Well, we don't see that there is a contradiction in those two different moves, simply because the Canadian economy is starting from another point. And since their situation is different, it is not surprising that the response is also different.
The highly anticipated ECB decision yesterday has been considered by some as a missed opportunity. Will this now place more pressure on policymakers, or is this simply allowing policy to rule the markets, opposed to the converse trend we've seen of late?
Well, the ECB has not the mandate to solve all the problem first. And the ECB can also do some rate cuts or other, I would say, measures later on during the year. The pressure is on the policymakers because the solution comes from them. And we need to go in a direction of more union. We need to tackle the financial problem, having more financial union, and that is what has been initiated, at least in the intention yesterday. And we need in the future to have more fiscal and budget union.
Following the ECB's announcement, the euro moved on a sharp uptrend. Can we expect this rally to continue?
Well, I don't see that as a rally, more like a correction, because there are very many undervaluation in the European market. The European market is cheap. But going forward, we expect the volatility to be very high in Europe, especially until mid-June, when we have the Greek elections and the Spanish bank audit. So we don't see that as a rally, but rather as a correction.
The Bank of England has held interest rates at 0.5% and left quantitative easing unchanged at £325 billion, despite mounting speculation that it would take steps to stimulate growth this month. The UK services sector, PMI, and the Spanish bond auction were considered to be the litmus test for the sterling off the back of this decision. Has it passed the test?
Well, we see the PMI or the Spanish auction as more like a long-term issue, but the sterling would react mainly to two main factors. First, it would react negatively to the weakness of growth and the austerity presently, but it would react also positively as a safe haven currency in case that there are additional turmoil in the Eurozone.
And finally, Thierry, if we take a look at all of the decisions that have been made this week, would you agree with them, or is there room for improvement?
Well, there are a number of quantitative easing or measures on that side which have been taken or not taken, but the point here is that those measures are mainly here to buy time, because the real solution should come from the politicians, and especially in the Eurozone. And as long as we are not having a clear plan and clear measures in the direction of more European Union, in the sense of fiscal union, budget union, and financial union, the problem won't be solved by any of the monetary or quantitative easing measures that we might see.
Thierry Cottet from Merrill Lynch Bank, thank you very much for your insight. We'll be keeping a close eye on the market movements in response to these announcements, so stay tuned to Dukascopy TV.